The logic behind the value factor. The source of the value premium has generated great debate among researchers. Many academics believe the value premium is an anomaly that contradicts the efficient market hypothesis. Researchers from the Behavioral School of Finance argue the value premium exists because investors make a judgment error when evaluating a company and overreact to the information about the company's past growth. They are consequently more inclined towards investing in growth stocks, causing these stocks to be consistently overpriced. On the other hand, investors are overly pessimistic about the future performance of value stocks, causing them to be consistently underpriced. Behavioral theorists also believe investors are more familiar with growth companies because they have heard about their past performance, and they feel safer investing in them because of this familiarity. While some evidence supports the value premium's behavioral explanation, overwhelming academic evidence supports risk-based explanations. For example, Naifu Cheng and Feng Zheng, 1998, found value companies possessed 3 logical indicators of distress or risk. These were: 1. Cutting dividends by 25% or more. 2. A high debt-to-equity ratio. 3. A high standard deviation of earnings. These risk factors correlated highly with each other and the book-to-market rankings of the companies the researchers studied. They concluded high distress, leverage, and earning risk all lowered the price of value stocks. In 2006, Lu Zhong concluded value stocks had an asymmetric risk, causing them to be cheaper than growth stocks. The risk of value stocks increases in bad economic conditions and decreases in good times. This is because the investment value companies make in production capacity is irreversible. Once the capacity has been scaled up, reversing it is impossible. Consequently, value companies end up with greater non-productive capacity compared with growth companies during periods of low economic activity, meaning their earnings decline more than those of growth companies. When economic activity is high, the non-productive assets of value companies become productive, whereas growth companies must first increase their production capacity. This means investors can expect the risk of value stocks to increase during bad economic times, when their employment prospects are also likely at risk. As investors tend to be risk-averse, they are more likely to invest in growth stocks. This aversion causes the price of value stocks to decline and the value premium to become persistent. Motohiro Yogo in 2006 also concluded that the returns of value stocks diminish during recessions. We can therefore say that value stocks tend to magnify the fluctuations of an economic cycle more than growth stocks. Simply put, value stocks are riskier than growth stocks, so the investors are rewarded with a high premium for assuming the risk. We can also test the value factor's logic by considering one of the metrics that represents it: the book-to-market ratio. Petercourt and Nielsen in 2005 adopted a leverage-based approach to examine the relationship between book-to-market and higher stock returns. They concluded that the book-to-market ratio provided additional information about a stock's expected returns and risk, which explained the power of the book-to-market ratio. Interestingly, the authors found the book-to-market effect disappeared when considering all equity firms. Had the value premium been an anomaly, the overpricing would materialize in all high book-to-market firms, and not just in high book-to-market, high-leverage ones. This was consistent with Petkova, who found that value companies tend to be those under distress, with high leverage and high uncertainty of cash flow. Therefore, value is a measure of distress risk. A 2014 study by Mohammed El Gamal and David G. McMillan examined 1927 through 2011. It showed a positive correlation between the default premium and value premium and provided the evidence for a leverage effect on the value premium. The default premium is based on the systematic macroeconomic risk, and the value premium is the result of the investor's logical decision-making. Finally, an extensive study by Angela J. Black, Ben Mao, and David G. McMillan examined the link between the value premium and macroeconomic variables such as inflation, interest rates, money supply, and industrial production. The findings of this study, which covered 1959 through 2005, included three important points. 1. Value stocks become less risky than growth stocks in expansionary periods, when industrial production rises. The prices of value stocks appreciate faster than those of growth stocks during good times. The spread between high book-to-market stocks and low book-to-market stocks shrinks, and the value premium declines. In bad economic times, the risk of value stocks increases faster than growth stocks. The spread between high book-to-market and low book-to-market stocks expands, and the value premium increases. A negative relationship therefore exists between industrial production and value premium. 2. The value premium also has a negative relationship with money supply. When the money supply increases, the price of value stocks increases more than that of growth stocks, and the value premium decreases. The opposite happens when money supply contracts. 3. The value premium is positively related to interest rates. When long-term interest rates increase, overall stock prices decline as stocks become less attractive than bonds. In a bearish market, the price of value stocks decreases faster than that of growth stocks, and the value premium expands. The opposite happens when interest rates decrease and the value premium shrinks, because the price of value stocks increases faster than that of growth stocks.